Now we did, if you guys are curious, my thing just went ding, ding, ding. We did just get put alerts on the SPY with the opening range, what we're looking at continuation pattern, but it hasn't closed there yet. So we still have some time on that. Going to trade that one this morning as well.
Yeah, obviously, Tesla shockingly at front and center in the news once again.
Yep.
Who could have guessed taking about an 8% beating today? So it's going to be interesting. I mean, I feel like I'm beating a dead horse at this point, but I almost feel like it's another opportunity to scoop up a little buy here on Tesla and just assume that it's going to bounce back on the dramatic news, just like it did the first Trump fight, the second Trump fight, and here we go again.
Yeah. Well, I hope so. It's been a great one to buy on every single fallout. Like today, Warren Buffett always famously said, buy when others are selling, sell when others are buying. And that's an opportunity here.
Yeah, I mean, let's just take a quick look at the numbers on Tesla. Let's just see if you wanted to trade this week's bounce back above 300, which is just kind of the midpoint of I mean, that's well below where it closed on Friday. Let's take just a quick look. You could do.
Do you have your screen shared by chance?
No, I didn't, but here, I'll do it real quick. You could do this 297.50 $300 call for $1. So you can make about 150% here and some change if you just want to trade. And again, that's trading for way down here, guys. That's not trading for it to make new highs. That's trading just for the midpoint of last week's candle. So, yeah, I'll do a couple. See, it was down at 95. Let's see if I can sneak in for around 95. Guys, this is one of those. Oh wow, insta fill. All right, well, probably paid a couple pennies too much. So that's a $2.50 wide spread there for about 95 cents. Stand to make about 150% ROI with about a 3% jump here in Tesla. Like I said, that's all the way down here. That's this line. If you guys can see my screen. As a matter of fact, let me just do a crazy one. I'm just a 4-day out. Let me just see if it actually got up to 310. What you could buy that for right now. Actually, not even that much better. So if you went all the way up to 307.50, 310, I mean, yes, it's a lot better, 50 cents, but I thought it might be like 20 cents. I thought you might be able to put a 500% ROI. Still pretty crazy here. I did this trade last week, by the way, on that little dump on Tesla. I forget what numbers did I do there. Let me see what I did there. Oh, it's not going to show me because it's expired. Anyway, I got a full profit on that one, like 120% last week on that little dump. So we'll see. Eventually, it's going to stop working, and Tesla's going to take another leg, another leg down on one of these hits. But for now, it seems to be worth buying the shakeups for outsized risk to reward. So there's a free Tesla trade for you if you want it. I'll type it in the chat in case anyone wants to follow along here on what I just did. But you can see that's my fill right there. 297.50, 300. I'll type it in the chat there.
It'll come in the chat here in a second. Now, you know who is just testing my patience right now is my good friend Progressive.
Oh, you talk. I thought today with a little bit of heat in the market, I'd finally get a nice pop.
Yep. It's testing my patience. It's done it before to me. I've sold before, probably about this time a year ago. We had a similar setup and I held it, same exact setup, knowing that it probably had about 10-20% upside. Held it for about 3 weeks. And I said, you know what? I can't wait anymore. Sold it that next week. Bam, 20%.
Yeah,
So
it's testing me as well. I'm getting sick of it. So I paid 95 for this one, guys. So ROI potential 150% plus if you get in for under $1. And yeah, the chat is open if you guys want to click that blue button and chat, to everyone. You can do that. It's just right above where you're typing. So yeah, that's looking for Tesla to pop above $300 a share by the end of the week. So that's what we're playing here. Same thing I did last week, by the way. Basically a carbon copy of the trade I did last week. What day of the week was that? Tuesday last week? We got that dump. Um, and it, popped, made about 120%, going for a little more. And we'll see. Like I said, it's a high risk trade. Tesla obviously is one announcement from dropping to 230 because Musk does something else. So we'll see. So far, it's kind of bounced back. I mean, you can see right here on the chart, we've kind of lived in this range. It had that crazy run up. The big fight dropped it down and immediately bounced back up to 325, moved all the way back above 350, then had the other one, then jumped back. So this seems to be kind of where it wants to squeeze around this 320. And I personally think it'll eventually break and head right back up, to all-time highs. Just a matter of whether that we're talking months or years. I really don't think as dramatic as some people would make it that Tesla's like done as a company, and just a matter of time. I think the opposite is true. It's a matter of time before it's all-time highs, in my opinion.
Yeah, they got some really cool stuff coming up. Now I am curious, and no judgment here. I don't really, you can have your own opinions. Did you guys all see Elon's whole tirade over the weekend about a third party, the America Party? I'm curious in the chat. Give me a yes if you're in favor of a third party that Elon is backing, or no if you think that's a not so good idea. And again, no judgment here. Everyone's entitled to their own opinions. I won't even give you mine.
I'm judging everyone very harshly. No, I'm just kidding. I'm just kidding.
Mostly knows, some yeses. On his poll that he ran, obviously, people who follow Elon on X probably like Elon. 67% said yes of a couple million people.
Yeah. Well, I think so. Walter said yes to third party, no Elon. Yeah, I think that's pretty common. People think that the party system needs broken, all that kind of stuff. Obviously, that's been a common consensus among the majority of Americans for a while. The question is whether you want Elon to be the one, kind of pulling the strings and all that sort of stuff. And I guess we'll find out. All right. Well, we have a ton to cover today. Thanks for being here. Hope you guys had a great weekend. By the way, if you guys sent me an email, I'm quite behind on my email, so bear with me. I'll try to catch up here by the end of the day. I actually pretty much didn't touch my email from Thursday afternoon all the way through today, so I am quite behind, but I will catch up. So if you're waiting on a response, sorry about that. I will definitely get you a response here very soon. All right, let's jump into our schedule for today. You guys should now see my actual slideshow. We've got a ton to cover in the markets, some headlines to cover. A quick little lesson I want to give you guys about hedging based on what I talked about Friday in Telegram, if you guys were following that. And then, of course, Graham's been hinting about the answer to the trader 1, trader 2, trader 3 question. Really, how do you build up the most profitable system over time? And I think what you're going to hear today, kind of the conclusion of that conversation that we've been having, and also the systematic approach, is a pretty cool exclamation point for what we've been talking about. So really excited about talking about that as well. So today, we'll talk about the biggest weekend news, market outlook, sector strength, weekly levels, some top ranked stocks. That's the new money crew, top ranked stocks there. Lesson for the week, and then driving that lesson of the week home with the systematic approach, and also talking about dollar trades, which like I said, are probably the best way to kind of conclude what we've been talking about for a couple weeks now with profit factor and everything like that. So weekend news, at least as far as related to the market, obviously there was some pretty horrific Texas weekend news as well. It's less of a market, just more of a real world reality. So thinking and praying about what's going on in Texas. But as far as the market news, the big beautiful bill was kind of front and center there. I don't think that this is going to be a big shakeup in the long term, in the medium term, or in the short term, to be honest with you. I think it's all kind of par for the course of what we'd expect, new administration to do. Raise the ceiling, spend the money, kind of what, both Democrat and Republicans have done now that we've gotten used to for a century. So I don't really think, as much as there might be some things in there, and there will be some things in there that are sector specific, that are either catalysts or pushing the market down. we'll see some of that. But as far as the general market goes, I think it's pretty much par for the course. What's interesting here is this one where, the dollar is continuing to be weakened. And I think that will be interesting to see if that holds up, or if a couple of those deals get in place, we start to have a little bit of a surplus. We start to see some of the positive side of the tariffs come through, because we will at least see some positive. Whether it's a net positive is a question that, remains to be seen. And I think most economists think not. I'm a little more optimistic about the tariffs than I would say most people. But regardless, there will be some positive. It's just a matter of whether it's a net positive. And if it's positive enough that we start showing some surpluses in some areas, it will be interesting to see what the US dollar does. I think an interesting trade actually is a long dollar kind of cost average trade, almost using it like a gold trade, where you put some dollar longs in place and then kind of average those out as a hedge, because unless you think BRICS or some other digital currency is going to be the superior currency within like the next decade, which I personally doubt very, very much so, I think dollar strength will balance back up. And so that's an interesting possibility there. And then, of course, we've got the Trump tariffs holding up rate cuts, which is kind of funny, just because the Fed is apolitical. They don't really weigh into politics, and then you've got all these statements that come out that are just so political. Because in reality, what the initial report said was that jobs are good enough, and some other key data points are good enough that we're not going to cut rates. And then Powell, in other interviews, basically said, yeah, it's all Trump's fault. We're not going to cut rates. So just very interesting to see how that goes. We've got the market making all-time highs last week, and now we're getting just a little bit of a pullback. So here's my question for you guys, and my question for Graham as well. Do you guys think we're going to see a retest here on the top of these highs before we were to go higher? Because I think Graham and I are both pretty bullish. We think that the Qs will, continue to go up. SPY probably hit 640 here sometime in July. Graham, do you think we get a retest, or do you think it's just, rocket fuel higher here?
I personally, I said this last Tuesday, I personally would love to just see a very mild cool off in the markets. I thought we were going to get more of that last week. Granted, it was, it's seasonally the most bullish time in the stock market, but where we are right now, technically, it would be really, really great if we could get that little mild cool off. But who knows? Who knows with this market, what it can do? Obviously, it's just going higher and higher. But, if we do get that, I'm going to just be mega bullish. If we don't, I'm still going to trade, but maybe not go all in on any certain position.
Yeah. Yeah, I'm curious if we actually go up a little bit more before we get any real 4 to 5% correction, mainly because we had this cooling off before the break. And I'm wondering if that then gives us a little more, like I said, a little more jet fuel to get up into the 630 or 640 range before we get that next one. Now, like Graham said, I'm, a retest is one thing, because to get back into the 600 level is about a 4% pullback. So that's one thing. What Graham's talking about is maybe like a very shallow cooling off here.
Yeah.
Not a 4% rip back down.
Well, no, I want to see if I want to be surprised if we go back to 613, right where those all-time highs were previously, and then go up from there. But I don't think we're going to go lower than that.
Yeah.
Unless
Yeah.
some crazy news happens, which we all know can happen.
Right. So I'm curious on that. I'll talk about the trade that I put on, which because of this market outlook, where I think that there's a pretty good chance we just get the jet fuel. But if we do get a flush, I have this trade on, which I shared in Telegram. I'll come back to this in a second. But basically what I did is I put a box around the QQQ. So this chart's the SPY here. I did it on the QQQ, where I put a box around the trade. You can see my box on the Qs is 570 at the top and 545 at the bottom. And so what I'm looking for, and by the way, the end of the box here that you see is July 18th. So that is the actual end of my box. And so if we do pull back anywhere near the highs that we broke out of, or a little bit deeper into that, kind of cooling off point that we just referenced, which would be like all the way down to 520, which I don't think that we're going to pull back there in the immediate term, but anywhere near those zones, I'm well out of my box and into a profitability zone. And if we get a move up 2 to 3%, then I'm going to be out of the box on the top side. And so for me, This is what I did because I wanted to have some protection if we were in fact overheated or again, news-driven market, so on and so forth. But I didn't just want to have a straight hedge that goes against everything else that I'm trading. And I'll cover more about that in a minute. But that was my approach here, to kind of have a hedge that's still not going to just kind of be downside protection, where if the market goes up, I'm going to be on my back here taking losses. But like I said, still pretty optimistic. We've covered this a million times. July is a heater. We expect July seasonally to be very strong. Highest percentages of profitability come in July, and the highest actual net growth as well comes in July. So both the percentages and the big moves are often colliding here in July. So the whole, sell in May and go away thing does not apply through July, obviously, with our strongest seasonal time. Another chart that we've showed you a billion times over is this insiders chart. I find it fascinating that even through this entire bottom that we got in March and April, we never saw the insider buying pick up. If you look at COVID or these other times where we've got 10% market flushes, this blue line, which is the buying here at the bottom, you will have seen go up almost every 10% correction. And we never got that. We got a massive buying spree on the retail side. The Robinhood traders certainly had the spike, but the CEOs, CFOs never really did jump into the market during that 10+%, which ended up being a 20% correction, and still never engaged. So I'm curious to see, do they start jumping into the party late, or do we just have CFOs, CEOs on the sidelines here for a year plus, which actually would be going on about 2 years plus, which would be about one of the longest kind of quote unquote sidelines that we'd seen there from the insiders, the executives on major corporations, going all the way back to like 2010.
Nate, I forget, do you pay for that, or is that a free source?
You can just get this for free. I mean, there's like a commercial thing. Let me grab the link here for you. It is openinsider.com. And if you want to just jump to that chart, you can go right here, openinsider.com/charts. So that one is, like I said, they might show you an ad or whatever, but you can get this and just keep an eye on it. I think it's a good resource, especially when the market's really bearish, because usually if they step in, it is the floor. When the market's bullish, I don't think it means a whole lot, to be honest, but just interesting because they never did step in on the downside. I'm keeping an eye on to see if they step in and kind of add a little fuel to the fire here later in the game or after one of those cool-offs that we're talking about. Now, here's a source I do pay for, which is the Darkpool Data. This is one that I think is interesting. I'm not a big, dark pool trader. Like, that's not like a catalyst or a trigger for me, but I like it as a confirmation. I like it to keep an eye on specific stocks to make sure they still have a lot of volume and interest on the institutional side. And you can see there, one of the stocks is one that Graham has been all over lately. That's Hood. Robinhood had about 9.3 million in the dark pool. That's just on the option side there last week. So that's 3.5 trading days last week. Hood piled up about 9.3 million. And you don't usually see stocks outside of the Mag 7 getting up into that 10 million plus range, like we saw there with Hood. Again, that's 3.5 days, so basically pacing for about 12 million in orders. So a pretty big run there. The rest of the top are pretty much ones you'd expect. NVIDIA now 2 weeks in a row just piling above everything else. In fact, 2 weeks ago, NVIDIA actually was ahead of any of the indexes as well, which is very, very rare to see an individual stock beat the major indexes on the total bullish sentiment. NVIDIA was about $10 million above the SPY 2 weeks ago. So we're seeing just massive institutional flow into there. A couple other interesting ones, a little bit further down the list, like Oracle and Palantir, kind of jumping back in. CCL, you see there. Of course, the rest going to be, your big tech stocks, your Mag 7, et cetera. Now, on the bearish side, obviously, you're going to see much smaller numbers here. But what is interesting is that the Qs are higher than the SPY. So if you go back here, you see SPY is 44 million to the bullish side, 7.6 million on Qs. Flip it around, you see Qs have 10 million and the SPY only 7 million. So could be some hedging there. John, I am sharing my screen. You might just have to move your screen view adjustment there in Zoom. So it might be some hedging here where the people are long SPY, short Q, some things like that. Also interesting to see technology, as we've been talking about, massively, quote unquote, overextended. I don't really believe in overextended, but XLK has been ripping up over 45% from the April lows, which is just an unbelievable run on technology. So we got some bearish flow there. And then you can see hood, maybe some spreads, things like that are shaping up that hood bearishness, or just some out of the money put protection, something like that. We've got HIMS, BABA, Twilio on that list there, but relatively small. We're not talking about tens of millions. We're talking about 800K, 900K there. So just a couple interesting ones I think to keep an eye on. Again, not something that I trade based off. It's not like I see a big order and then I jump into a trade. I would trust Lance more on that kind of thing, but just something I like for confirmation. We've talked about the sectors. XLI has been the best sector year to date, and especially because if you look at the dip on XLI, yes, they had a big dip, but compared to the XLK dip, which is now the second or third strongest sector, not nearly as extreme, and still maintaining the highest. Now, looking at XLK, it's kind of a good example of what we're going to talk about here in just a moment, about why hedging often isn't the best idea, because the same sector that took the deepest plunge here of about 22% is also now up over 10% year to date. So again, XLK took the deepest flush, also had the best recovery there, and is up over 40% from the April lows. Now, if you zoom in a little bit, the last 30 days, you can kind of see where XLK has done. This is going back to June 7th. So this is just the last 30 days here, June 7th. And you can see it's kind of risen above the pack pretty dramatically. Now, what I like personally are these sectors that are kind of hanging out right here over the last 30 days. So still bullish, still in good shape, but maybe not quite as overextended as where XLK is. So that's XLC. XLY, you have to be a little bit careful with, I think. But XLC, XLI, I think are good ones there. And I think, Meta and Google are in great position here to continue to lead the pack on the communication style. XLY, like I said, a little more daring if you want to be in that. You're going to have a lot of Tesla exposure there and things like that. And the one that Graham always shares for July is this chart here, infotech, financials. I think we both agree, yes, real estate historically very strong, but not one that I'm super interested in trading aggressively. AVGO was one of these infotech stocks that we talked about last week that I think is continuing to pour on the momentum. A lot of the financials are ones we trade in the income machine because they were at all-time highs. They had broken above key levels. We talked about Bank of America here and this $48 level, which was one of our weekly levels to watch last week. Here it is after last week's candle, clearly broke above and now headed back or headed into the kind of uncharted territory here, potentially above 50. So Bank of America, Visa, Citi, BlackRock, Wells Fargo, all of those financial stocks really ripping, and most of them breaking all-time highs. And financials continues to be a very hot seasonal stock heading into July. So I like Bank of America. I liked it better when it was just breaking above 48, but I still think it's a good one here. Of course, ANET is one we've talked about a lot. And our level last week that we shared last Monday was $100 a share on ANET. We did break that successfully, but we're still just kind of chopping. We didn't get that full move on ANET. So I still like it. If it chops right back, I don't know what ANET opened at today, Graham, if you know.
It's 102.
Okay, so kind of right in this zone. So I think if it stays above 100, trading it bullishly and hoping that we catch some fire here and move up again, assuming you like me think July has some firepower left. I like it to make the move. I think it's like PGR, might take some patience, might have to hang around here. But my guess is we're going to move sooner or later. And it's a risk reward play. Yes, ANET could just end up being kind of a failure. A lot of these stocks that are in ANET's position in previous pullbacks. In other words, they were the winners from the last bull market. They never become the winners again. That happens. ANET could be that stock, but I kind of doubt it. I'm more bullish on ANET than that. And if it does flush back down, it's just a risk reward play for me. So you get in this 100 range, you target 110, 115, 120, something aggressive like that. If it fails, okay, you lose the price of your option. If it does make that move, you have a really nice positive risk reward on ANET. So that's the way that I would play it. Marvel is one that I shared last week as well, by the way. Still right in this position below 80. If it breaks above 80, whole bunch of green, wide open space there on Marvel to take a look at. So keeping my eye on Marvel as well. And then one that I think is interesting is MSTR. So MSTR obviously has that crazy highs from when we ripped on the previous Bitcoin all-time high run, made another run, pulled back, and now we're sitting in this 400 to 450 range on MSTR. The reason I think that it's interesting is because a lot of the other Bitcoin related assets are kind of trying to front run Bitcoin right now. They're trying to actually get above it. Like Coin. Coin is a stock that, if you look at it right now, it just started getting ahead of Bitcoin and making a move toward all-time highs and then cracked all-time highs. MSTR didn't quite do that. And so I think if we get a move above 430, certainly above 440 here, this number is like really actually like 435 or 433 or something like that. But if we break that level and make a move higher, I think MSTR could easily jump right back up to $500, 500 plus a share. So again, I think of a lot of these as more risk reward plays. So if you can get into a trade on MSTR that trades it toward the end of the summer, into the September monthly expirations, and you trade a 510, 520 MSTR debit spread, you could get a pretty massive risk reward. In fact, if we just quickly look at it here, and we'd go to MSTR, and you go out to September, that's about 75 days, and you go all the way up. I can't even go that high with my preset selection here, but you go all the way up to a 510, 520. You're gonna be able to trade this for about $1 or $1.25. So it's like an 800% ROI. Definitely a high risk trade. You're basically betting that Bitcoin's going to rip, MSTR is going to catch up, start front running it, and come toward all-time highs. So super high risk, very aggressive trade. But for an 800% ROI, I think these are the kind of trades that make sense, similar to like the Tesla one that we took during the round table. So for me, once again, hopefully you guys aren't sick of me hearing this, but a lot of times these trades I like more in terms of their risk to reward than high probability setup. I don't think I'm ever going to trade MSTR as a high probability trade. I'm going to trade it more as an outsized risk reward. So just one to keep an eye on. And if it breaks above 430, 435 in this range, I think you got some open space here for MSTR to run.
And I think to just kind of break down what you're saying, because we're getting some questions here, why wouldn't you do in the money, guys? If you have a volatile stock that really has a lot of potential to go up, I mean, MicroStrategy, it goes up 10% in a day, like half the time. When you have a stock like that, it might make more sense to play a little bit more risky, more of a lottery ticket style, because it can make that move and you can see that 200, 300% gain depending on the options you're picking versus a good stock like GE, for example. General Electric has been chugging. It's not going to make 10% move in a day. That's one where we would probably look to go deeper in the money to then just get that safe and steady income play.
Yeah, absolutely. And if you guys are thinking, well, I could use that volatility to my advantage by getting more cushion on the trade, that's true. And I don't have any issue trading that way. I think last time I looked, you could get 8% cushion on MSTR. When I say cushion, I mean room for air, room for the stock to go get against you and still make money. So you could do it that way. But what Graham's saying is the disproportionate potential of something like MSTR versus a stable stock that we like trading, like Walmart, GE, I mean, even Progressive, even though it's been annoying, where you can get, say 5% or 6% of cushion on that stock versus 8 or 9% of cushion on MSTR. It's disproportionate. MSTR could flush that 8% cushion in an afternoon easily, whereas, Walmart, GE, those kind of stocks really aren't going to move almost ever to the downside in that way. So I would rather trade the Teslas and the MSTRs, even the IBITs, usually for the aggressive risk reward. Now, I still check them on the income machine. I still see if they're going to give me a 15% cushion to trade it for income. I have no problem doing that. But usually I like using the volatility to my advantage and looking for an opportunity. The example I gave Charles was this 510, 520. So you're trading it pretty much toward all-time highs. I don't have this trade on. I haven't actually traded MSTR yet. I'm going to wait for it to crack above that 430. Wow, I can't even talk. That 335 number. If we get above that, and no, 435. Well, I'm struggling here. This 435 number. If we get that, we'll see. Right now, it's still close to 400, so we need about a $30 move before we would get back above this level. So that's kind of what I'm waiting for, is a 435 break. Like if we get a weekly close around 440, then I would take it, kind of chasing some of this wide open space here, because we'll have, basically $80 to $90 of open space between that and the all-time highs. And so that's kind of what I would look to take for MSTR. All right, let's take a look at the New Money Crew top-ranked stocks here. We've got Goldman Sachs and Citi, no surprise, with some financial stocks. AVGO I highlighted there because that's one we've talked about. We talked about it last week. It had a really nice recovery. If you guys remember, AVGO flushed last week. Really nice recovery to finish actually above the highs there. Still like Google. Google didn't really do a whole lot, but still like that as a potential trade. It's getting more institutional flow. I think that it's going to be a good winner on the XLC side, just moving a little bit slower. It's interesting, the Mag 7, we've had some really nice moves, but about half of them are still lagging behind the SPY and the QQQ. I mean, Google has lagged behind, Tesla's lagged behind, Apple's lagged way behind. So about half of them are really struggling here, and I still expect that they will be the ultimate winners in the bull market. So I still think that they will catch up and make a move. And so I still like Google. I still like Apple. Apple is one of my bigger positions now, based on just where it's at technically and the fact that I expect it to catch up. And Google is in a similar category. Now, Google, I have a lot less long-term confidence in. So I would actually say that I'm most bearish on Google of the Mag 7 over the long term, just because even though they've done a great job diversifying, I don't know how well they can replace the power of search in their business model. And I think search is going to die and already is pretty much dead for a whole key demo, and will die off. So Google's done a great job diversifying. I don't know if they can diversify and maintain the valuation that they've been at. And so long term, not a huge fan of Google, but I think short term there's some catch up room there. And again, it's New Money Crew top ranked stocks. So that's why it's on our list right here. NVIDIA has made the list a couple weeks in a row, has really done a good job. NVIDIA, frankly, I was also not super bullish on just going back 3 months ago. I mean, I held it. I think it still had tons of upside. All of that kind of stuff holds true. But I was concerned that it's just, they might have some other competitors. Some of that, DeepSeek news might have legitimacy of how cheap it is to recreate what NVIDIA does, so on and so forth. But it seems like that's just not real. NVIDIA's earnings were once again top of their class. The other Mag 7 stocks are doing massive amounts of business with NVIDIA, and they just seem to be holding that position as the top dog. And so I think that we'll see NVIDIA continue to kind of lead the pack until that no longer holds true. So we'll see. I'm holding NVIDIA. And we'll see it's kind of momentum right now, as long as it maintains that top spot, kind of the tech or the chip stock mega leader, then I'm not going to argue with it. The reason Google, Charles versus Goog, is just because that's where the institutional order flow came in, was on the GOOGL ticker versus the GOOG ticker. Then LRCX is another one that made our list here on the New Money Crew group, and so wanted to give that one as well. I'll pump these in the chat real quick for you guys if you want to take a look. Couple of stocks there. If you guys signed up for the New Money Crew newsletter, you'll start getting that this week. Pretty excited about that. Top stocks coming at you every day, every weekday, in the New Money Crew newsletter, and some good bonuses along with that. All right, folks, let's move into the lesson of the week, which I'm calling Why Most Hedges Don't Work. I'm just going to give you a short recap. I have a plan to do a much deeper training on this here pretty soon. But for me, this is going to be just a short, very general recap of this. And then, like I said, we can go deeper in some other sessions. So hedging is definitely a popular idea, basically because it sounds good. It sounds like, hey, as a trader, I should have some protection. What if the market goes down? All of that sounds very reasonable. The problem is most traders just really don't execute this idea of hedging well. So today I'm just going to walk you quickly through the numbers, a basic example of a basic hedge, and why I'm simply not a fan of, hey, if the market goes down, I'll save a little bit of cash under hedging market. So if you take a profitable system and you add a just-in-case hedge, you will typically weaken its performance over time. Okay? Glenn, no, this is Opening Playbook. This is our free session we do every day at 10 a.m. Market outlook, trade ideas, lessons. So this is that's what you're in right now. So if you take kind of a profitable outlook, a positive expectancy, and you add a just-in-case trade, what you're typically going to do is you're just going to carve some of the profitability out of the system over time. So let's take a strategy with a 75% win rate, an average win of $80, and an average loss of $100 as our here. Okay, which of course would be a very profitable system. So over 100 trades, what your regular expectancy would be those 75 wins times your $80, so $6,000 in gross profits, 25 losses times $100 is your average loss, with $2,500 in gross losses, and then your net profit here would be about $3,500. Okay, so if you wanted to add a $20 hedge into every trade that generates $50 when the market goes down, so that your loss, you kind of add some protection to your losing trades, what happens to your numbers? And by the way, $20 to make $50 is actually a pretty good hedge. It's actually pretty hard to get 150% hedge baked into a normal trade when the market goes down. So this would actually be, in my opinion, a pretty effective hedge over the course of those trades. Well, over 100 trades, what would happen to your new expectancy would be you'd have the same 75 wins, but you'd lose the $20 on all the winners, right? Because that's for your downside protection. And so you'd have the $80 minus $20, and your new gross profit would be $4,500. But your 25 losses would have that $50 hedge baked in, and so you'd much reduce your average loss down to $1,250, and your net profit would go to $3,250. So it was $3,500, now it's $3,250. So in other words, that's a lot of extra work and execution just to lose a couple $100 over the course of time. Now, obviously, that's a very generalized example, but in reality, the results would probably be worse in most hedges because of the way that hedges operate in real markets. Okay, so the way that hedges typically operate is that's actually very hard to get 100% on a hedge. You typically have to manage the trade very well to even get the maximum profit potential of a hedge. And then in most scenarios, the real danger of a hedge is that it often loses in multiple situations. In other words, a typical hedge might look something like this. Here, I'll give you an example where you have a market that you want to go up, and then you have some puts down here. And then when the market doesn't go up and it goes down here, you lose money, but your hedge didn't quite make you any money because it didn't go down far enough. So you just lose some extra money. And so that's often very difficult to do where you want a hedge to actually protect you. And then if you want typical hedges to work like gold or bonds or things like that, well, they certainly don't tend to work very well if you just look back at 2022 or other times. So one way to hedge, while not just taking money out of your winnings, is using a two-way trade like what I shared on Friday. So this is the big trade that I put on. I put on 100 contracts here on the QQQ, and the idea was I'm not just going to put a put on, I'm not just going to have a put that if the market goes way down, I make a little money and it reduces my losses. I'm going to put a trade on where if the market does flush, I'll make some money. But if the market continues rallying up, I'll also make some money. And again, so this trade was to put a box around the QQQ. I did that by pairing a bullish debit spread and a bearish debit spread. So my bullish debit spread is the call side. It's the 560 here. You can see the 560 and the 570 call. So that made this bullish debit spread here. Then I paired that with the 545 and the 555 bear put spread. That made the bottom line here. And so my top line is the 570. This is on the QQQ. And then my bottom line of my box here is this 545. So that created a box where if the market flushes back down and goes below 45, this trade will be in the money. And if it continues to grind up and gets above 570, then it will also be in the money. 570 from Friday's close was only about a 2% move, 2% and some change. We're not talking about a massive move. And I expect that if July does continue gaining momentum, it'll probably be a 3, 4, even 5% month up if we get that, like I was saying, kind of jet fuel added on. Again, if we flush, even if we flush only 2%, I'm still going to be comfortably below this line in the sand at 545. Now, there's another element. Yep, right around the closing price you see here on 556. There's another element that I added on to this trade, which is that I'm not just waiting for it to expire. I actually have targets on the trade. Because if the market does flush down, in my opinion, it's pretty likely that it's actually going to bounce back up and finish right inside this no man's land. So the way that I handle that is by putting a target on the trade so that if it flushes, I can get out of the trade with profit before it has a chance to bounce back up in no man's land, because anything inside this box is going to be no man's land for me. So what I did is I set 50 contracts to close at $7.99, and then I put an additional 50 contracts to close at $8.99. So for me, this is how I set up the trade, where if I get a big move to the downside, I want to go ahead and take some profit before it bounces back out. And if I get a big move up, so if the market does, let's say Trump says, hey, 90-day tariffs are being extended for 100 days, which he said he's not going to, but let's say he does, and the market pops 4%, I also want to get out and take some money here, because if it cools back off into no man's land, I also could take a loss. So I have a target here where if the market makes a big outsized move in either direction, I'm going to be in good shape. And by the way, if it just grinds up slowly, I'm also going to be fine because it'll get it back above that level if it grinds up. If it grinds down, I should get below that level as well. We're only talking about a 2% move on either side. Okay, so just for some extra explanation, this is a way that you could put on a quote unquote hedge. But if you're right and you're playing aggressively to the upside like I am, you're not just costing yourself money. Because most hedges, it's like, hey, if I'm right and the market goes up, I just wasted $1,000. I just wasted $5,000, whatever your hedge is. Here, I'm trying to give you an opportunity where you can set up a trade where if you're right, you're actually adding some profit onto the pile. While if the market goes down, you do have somewhat of a hedge there in to reduce your losses. Now, you're not going to make up, assuming that you have a normal sized hedge relative to your account, you're not going to make up a net profit in most cases. It's just going to reduce some of the damage that you take in your portfolio. So again, one way to do that with both sides having some protection there. Now, speaking of systems, we would be remiss to not talk about what we've been focusing on lately, which is profit potential in its truest form, not profit factor or any other statistic, but what actually generates the most money. And so today, you're going to get the answer to the question that we've been posing, and also what we think is the best solution in terms of how to actually trade that functionally in real time. So let's go review which trader makes more money. Really, the most important question that we've been asking in the opening playbook for the last couple of weeks.
Yeah, let's take a look at it. If you guys were here I'm going to show you trader one and two again. And if you
You're
weren't here, you'll probably be blown away, just like everyone else was. But then I'm going to show you trader number three. And now the trader one and two are based on hypotheticals, just to establish what I'm about to show you. But trader three is based on very real trades, and you can be trader number three. I can show you how to do that and target these types of returns. But first off, let's go ahead.
Well, just to recap, when we showed this, a lot of people said, hey, it doesn't really matter. We don't have enough information. It could be trader one if he has a high enough, blah, 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 blah. And then we showed this, and everyone, including me, said trader one at that point. Um, because we've been taught, at least I've been taught, that profit factor means profitability. Like, of course, what else
Sounds
would
like
it mean?
profit factor. What is your factor of profit? Well, if you
Uh,
break it down, yeah.
Yeah. So then we got into this. I'll let Graham take it over. But, the average return being 20%, I still would have said, yeah, but if you bake it all in, the profit factor must mean a certain amount of trades. It still has to work out for trader one until the actual dollar amount with, same amount of trades, same risk profile gets you into this situation where trader two makes 5.5 times, well, 5 times the amount of money.
Yeah. And with one fourth the profit factor. So the question is, how can that be? And we all came to the conclusion, we can all agree now that win rate doesn't mean anything. It's an arbitrary number. Profit factor actually doesn't mean anything either, which was a shocking realization. The thing that matters is your average return size per trade. The trader one had that great profit factor, but his average return, when you average it all out, wasn't that great. He makes 4 grand, almost 4 grand after 100 trades. Trader two has a 20% average return. He's making 20 grand. So that return size is what really matters. And Dave, when we say same risk profile, we really just mean this is based on a $1,000 starting stake for both. No compounding, nothing like that. Just flat $1,000. They both start with the same amount. They trade their separate strategies. Who makes more money? Trader two. So again, to debunk this profit factor myth, in this example, trader one, after placing 100 trades with $1,000 in each, makes 4,950. Trader two, because his average winner is about 100%, makes $60,000 in gains. But here come the losses. This is what hurts the profit factor.
Yep.
Trader one barely takes any losses, just $1,000. Trader two takes 40 grand in losses. That's why you have that difference of profit factor, which is just the gains divided by the losses. 4.95, 1.5. But at the end of the day, Trader two is taking home the bacon. He's making a nice little side change in the stock market. Trader one is barely making enough to even write home about.
Yeah,
So
and
that
obviously that $40,000 in total losses means nothing. It throws you off, but it means nothing in any kind of real trading scenario. Which I guess I never realized was the way that ended up baking into profit factor until we really broke this down.
well, and that's because the gains are so big. I mean, if he had 4,950 in gains and 40,000 in losses, that would be terrible. But because his gains, his average returns are so big, it doesn't matter what his profit factor is. He's making a lot of money, 5 times more profitable than Trader one. So obviously you don't want a strategy with a profit factor below one, but it should be shocking to you that a strategy with a profit factor of 1.5 can truly be 5 times more profitable than one with nearly a 5 profit factor. Well, now today I want to introduce to you trader number three. So let's ask this question again, which makes more money? And I'm going to break it down step by step. You know trader one, you know trader two. Let's look at trader three. 66% win rate, 208 profit factor. Average winner, 93% on the average winner. Average return, whoa. Remember, this is the most important number, 32% per trade on average, winners and losers combined. Well, trader three at the end of the day makes $32,000, nearly 10 times better than trader one because that average return is what matters. So here's what we want to talk about today. Which one would you rather be? Post in the chat. Would you rather be trader one, trader two, or trader three? You can see all the stats. You can see the win rate, profit factor, average winner, average return, and then who's making the big money after 100 trades. Everybody wants to be trader three. They want a shot at $32,000 after 100 trades. This is again based on $1,000 starting out. No compounding, nothing like that. Everyone's got the same approach here. Well, obviously, you don't
39
want to be trader
versus
one.
32.
You want to be trader three, about 10 times results. Not a hard decision to make. But what if I told you that trader three, right? Trader one and trader two were hypotheticals. Trader three is not based on a hypothetical situation. It's not a back test, nothing like that. It's a strategy that I've been using for a few years now, and it's one of my favorite ways to trade each and every week. So if you want to learn how to be like Trader 3, go ahead and give me a yes in the chat because I'm going to cover it today step by step. So by the end of this class, you have a chance to be trader number 3. And the cool thing about this, I can't promise future returns. You guys know this, but the way we're trading, we are always, every single winner is going to pay right around 100% ROI, which keeps our average return so big where we're able to smoke the overall profit of both trader 1 and trader 2.
Yeah, and like Graham said, so it's not hypothetical. Those are real numbers, and that's actually, if you guys want to know how we discovered, I should say Graham discovered, because I have to give him credit. How we discovered profit factor was kind of a scam, is because we were looking at the dollar trade sheet and the real money portfolio was growing so fast. And we were saying, how is this thing racking up so many? I mean, it had a 2+ profit factor, which is phenomenal, but compared to some things that had a 3 profit factor, and it was racking up profits faster than any other system, we were saying, well, how is that even happening? And that's actually what led to the discovery of everything we were talking about last week. Wasn't a theoretical discovery. It was based on real trades and the actual live performance that Graham had put together on these dollar trades. So that's what we've kind of been leading up to, organically and kind of accidentally leading up to as we've been through this discovery process, and why I'm excited to finally get to cover it today. So,
oh, we got a little recording action.
Okay, the recording jumping on there.
I think it should be on, right?
Yeah, let's see. Do we get it started? It says not started. I think.
Oh gosh, you guys are all good. Sorry, for some reason Zoom gave me an error and turned it on and off.
All right, there we go. We're on. We just wanted that robot voice to talk to you a couple more times.